Hello and welcome to Moneylife News and Views. I'm Debashis Basu. For a country facing multiple headwinds, India looks oddly relaxed. The stock market still hovers around the record highs, although it's just come off the last couple of days. Shopping malls are busy, interest rates are stable, car and bike sales are rising. High end property sales are strong. To investors and policymakers, this feels like smooth sailing. That confidence could be misleading. Beneath the surface, India is entering a slower phase, one defined by five forces. These are high government debt to GDP, a slowing domestic revenue growth, lower household savings, a more hostile geopolitical environment, and, of course, populist politics. India has managed each of these forces separately in the past, but together they threaten to undo the growth narrative on which today's optimism rests. Let's take each of these one by one. Number one, debt. The finance minister has declared that reducing debt to GDP ratio will be her core priority. According to International Monetary Fund, India's debt to GDP ratio is above 80%, which includes the combined debt of central, that is union and state government debt. But how will the government reduce debt? According to several fiscal estimates, four fixed overheads: salaries 28%, pensions 15%, interest on existing debt 25%, and subsidies and welfare 15%. These four together absorb more than 80% of government revenues, leaving little room for debt reduction. In a recent meeting with the Prime Minister, economists argued for reducing capital expenditure to cut debt. But since the government capex has been the single most important engine pulling the economy for the past 3 years, what will happen to the GDP growth if government capex is cut? We are indeed between a rock and a hard place. Point number two, slower revenue growth. Debt would not have been a problem if India's revenue base was robust. But after 3 years of growth, India's main revenue engine is losing momentum. In December, net collections from goods and services tax, the most reliable real time indicator of economic activity, grew by only 2.2%. Underneath this headline, nearly half of India's states are stagnating or shrinking. Big consumption states like Tamil Nadu, Kerala, and Madhya Pradesh have recorded declines. What is propping up the aggregate number is a narrow set of manufacturing and logistics hubs that benefit from import linked taxes and integrated GST settlements. Refunds are rising. Consumption is no longer driving revenues the way it should in a healthy, expanding economy. A government that wants to reduce debt cannot do so on a revenue base that is slowing down. Point number three, lower household savings. India's growth model depends on domestic savings. For decades, households provided a deep pool of capital that funded government borrowing, corporate investment, and bank lending. But household financial savings have fallen from around 10% of GDP to barely 7%. This is an ominous sign. Household savings are down because employment is sluggish and real wages are stagnant. This is also borne out by the slow mass consumption. People just won't have more money. Point number four, geopolitics. This is the single biggest factor and is going to remain so for the next 3 years. This is something that has blindsided Indian policymakers the most. When Donald Trump came to power, a section of Indians in the United States and in India celebrated, banking on Trump's friendship with the Indian Prime Minister. But Trump has turned out to be a nightmare for every single country on earth. While many of them have managed to negotiate their way out of high tariff that is imposed, India is one of the few large economies not to have secured a durable trade accommodation with the United States. India's exports of roughly $50 billion to the US have faced mounting pressure. Trump has also just upped the ante enormously. He is no longer seen as an all noise and no action. He has ordered that Venezuela's president be picked up and brought over to the US to face trial. He is planning to annex Greenland and has Canada, Colombia, Mexico, and many other countries in his crosshairs. He has backed proposals to impose extremely high tariffs on countries importing Russian oil, which will include India. Meanwhile, Indian policymakers have remained confident about free trade agreements and export opportunities outside the United States. They look increasingly naive in the face of Trump's willingness to use coercion for economic ends. He has publicly mocked the Indian Prime Minister and has shown little patience for strategic or diplomatic niceties. India, unlike China, lacks the scale, leverage, and financial firepower to absorb such blows. Point number five, domestic populism. When growth slows and jobs disappoint, the response is rarely fiscal prudence, it is populism. Subsidies, loan waivers, cheap credit, and public hiring are the tools through which Indian politicians buy stability and win elections. The 8-pay commission looms, which will push fixed overheads even higher. Cutting debt, as the finance minister wants to do, is sensible. Comparative politics makes it extremely difficult. For example, while the Reserve Bank of India had cut policy rates by 125 basis points and is signaling easier monetary conditions, government-backed small savings schemes continue to offer high tax advantage returns, limiting the ability of banks to pass on rate cuts. Put together, these five forces will reduce economic growth given that India is not becoming significantly more productive or more export competitive. For the government, slow growth will hurt revenues, constrain spending, and keep debt and interest payments high, leading to further borrowing. Companies will continue to shy away from expansion. For households, it will mean suppressed wages, slow consumption and savings, and rising borrowings. None of this is yet fully visible in India's headline numbers, which look good, but the signs are emerging. India is heading into a period in which the margin of error has vanished. If you like this video, please share and do subscribe. Thank you.